Mark Zuckerberg's Harvard classmate on how to build a startup machine. Only 40% of seed-funded companies make it to Series A. So how can you tell the unicorns from those destined for the glue factory? Welcome to I See Your Trade. I'm your host, Pamela Ambler. Soon we'll be joined by our special guest, Magnus Grimeland, former Zuckerberg Harvard classmate and founder of Antler, the world's most active seed investor. Then later, our resident expert, Oxford economics economist Alex Holmes, to unpack some of the numbers behind the meteoric rise of unicorn startups. First, though, as an illustration, famous investor Peter Thiel put in $500,000 in the seed round of Facebook. When Facebook went public in 2012, this was worth $500 million, from $500,000 to $500 million. That's a return on investment of about 100,000%. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Magnus, you went to school with Mark Zuckerberg. Was Facebook the catalyst for starting your Antler startup machine?
So basically, I'd been to the military just before I came to Harvard and started off doing business, and very quickly saw this second wave of startup being built. So we always have the dot-com boom and bust, and then 2001, 2002, things were a little bit quiet, but then a lot of really great companies were being started, and Facebook was one of them, and we were right there. And yeah, for sure, that ability to influence so many people over such a short period of time got me very inspired. It was a very exciting experience.
And before you started Antler, you co-founded Zalora.com, which you sold to the multi-million-dollar global fashion group. So you have your own runs on the board, and now you're going again with Antler. What is it about the startup world that's so appealing?
Well, we fundamentally believe that the world will only move forward if great people choose to innovate. And if the smartest people in the world choose to solve some of the world's biggest problems, then the world becomes a better place for everyone. So I think ultimately, on the grand scheme of things, that's what's very, very exciting. But then if you go down into the micro, it's so exciting to take an idea and turn it into reality. And that experience of doing that with Zalora, we saw this opportunity here in Southeast Asia. It's just exciting to see things come out of nothing to become something which is still now, many years later, the biggest in this industry.
And how does Antler's seed funding machine work? So on the one side, you have the fence, you set up a fund with a pool of investors, and then on the other side, you invest in early stage startups. So what comes first, the fund or the founders?
So ultimately, the great thing with what we're doing is that we're all in the same boat. So Antler will only be successful if our founders are successful. Our LPs will only be happy if our founders are successful. So what is the most important is the founders. That us finding the most exceptional people that are excited about solving important problems and being a very good partner to them in the early days is everything that matters.
And early stage investing, it can be incredibly lucrative if you back the right company. But what sort of success rate is the industry standard? Out of 10 startups, how many would you typically fail and how many would you be ultra successful in?
Well, so in Antler, the success rate is so far very high. We've only existed now for a bit more than 5 years, about 5.5 years. So our companies are, relatively young, but the failure rate is very low. It's in the teens so far. If you look globally, about 99% of startups typically fail. But if you look at why they fail, it very often comes down to it not being the right co-founder team, or the co-founder team having chosen to work on something which is not really solving a real problem. And I think if you focus in on those two aspects, ensure we have an incredible team that is working on something that really makes sense, you take away a lot of the risk.
And what would you say is the appeal for investors to invest in early stage startups? How much is it about the thrill of potentially backing that unicorn?
Well, I think part of it is obviously the economic return of doing that. And done right, early stage investing is an incredibly attractive asset class. But part of it is also what I spoke about earlier, which is the impact of backing people in solving important problems and making the world a better place, right? If nobody put money behind new people who want to innovate, the world will, very quickly come to a standstill. So definitely the number one reason why people invest is the excitement about the opportunity to generate really great returns. But it also comes, I think, with a responsibility towards society to not put everything you own into real estate and stocks and bonds, but actually back the next generation great entrepreneurs.
Right. Now, the rule of thumb for most investors is to only invest between 5 to 10% of their portfolio to startups. Do you agree on that? Or is that percentage changing?
So I think 5 to 10% is actually a very good guideline. I think it depends a little bit what you're investing for and how much money you have to put into things. If you have a smaller amount of money and you're saving up, perhaps you take a little bit smaller percentage because it is a risky asset class. And then if you have a bit more capital and you're a little bit more long-term in terms of how you want to deploy, and it's a little bit less necessary for you with short-term liquidity, then you can increase that percentage. I think everyone should have a small percentage towards it because, done right, it does deliver really great returns. And there are ways to reduce the risk of early stage investing.
And you've been in this game for a while now. What are the key success factors for a startup? Can you talk us through your investment checklist?
So number one, it starts with an incredible founder, right? If you find an incredible founder, that founder will surround themselves with other great co-founders, which will form an incredible team. And if you have an incredible team, they will typically choose to work on building something that really makes sense. And the earlier you go in investing into startups, the more important the quality of the founder and the team is. Then the further down the line and the closer you get to an IPO, the more you would treat that investment as a public market investment, right? You start looking at metrics of the company, product market fit, growth rates, unit economics, all that type of stuff. So there's a sliding scale as you get closer to an IPO. But in the beginning, the very most important thing to look at is how strong is the team and are they really working on something that makes sense? Because if you have a great team, you remove a ton of the risk. So a lot of our investment thesis is finding those exceptional people. Take Elon Musk, probably one of the most successful founders today. Backing him in the early days of SpaceX, in the early days of Tesla, you probably didn't back the idea, but you backed the individual based on the track record that person have. And I think the earlier you go, that's the most important.
If we look at sort of a decade ago, seed money typically was just around $1 million. And of course, with inflation and over the years, now it's at least 3 times that amount. Why are the seed deal sizes getting so much bigger?
Well, I mean, part of it is what you mentioned, like costs have gone up for certain things. Part of it is also that it's way more capital available, right? Look at Southeast Asia. When we were building Solora, from 2012, 2013, about $250 million a year was deployed all across Southeast Asia into venture capital. Fast forward to today, it's about 25 billion. So the amount of increase of capital availability in the region has gone up massively. And it's been the same in any single ecosystem in the world. So probably today reflects more what is actually needed to increase the success rate of startups. So yes, people are raising more money in the early rounds, and yes, some costs have gone up, but the ability to scale much more cost effectively is at the level where it's never been before.
And the roads are there already.
Yeah,
because you
and the
built
roads
them.
are there.
So what about the probability of advancing from the seed to Series A funding? Is that improving?
Yes, for sure. I mean, obviously there was a bit of a peak in 2021 in terms of access to funding, but great companies today can still easily raise seed, easily raise Series A. It does take a little bit longer time than it did in 2020, 2021, but I think it's more a reset to the normal than the world actually go in the opposite direction. And also it's much better starting a new company just after peak than at the peak. Actually, historically, the world's very best companies typically have a tendency to be started in a downturn and not at the very top or on the way to the top, because they're going to exit 7, 8, 9, 10 years into the future.
So the better companies are actually coming because we're kind of moving into a recessionary territory now.
Yeah, no, I mean, it doesn't really matter whether 2022 was a bottom, 2023, 2024. From a startup perspective, what matters more is 2021 was a peak. And if you look historically, if you look at Fortune 500 companies, actually 30% of them were started just after peak, which only represents about 10% of time. The same is happening now, I think. Like, the best venture returns in the world up until the global financial crisis was the 2000, 2001, 2002 cohort. After financial crisis, it was the 2008, 2009, 2010 cohort. And I fundamentally believe that the companies being started today and 22, 24, we're probably going to see some of the kind of highest value creation ever.
Now, what is your advice to startups in attracting seed funding? What do they have to do in order to get investment?
So I think the number one thing is you need to be convinced why you are a great founder and why you have assembled a great team. If you are not convinced about that yourself, it's going to be hard to convince someone else. So it kind of starts with like convincing yourself. Then it's much easier to build a great business if you're 2 to 3 co-founders than one. You can succeed as one founder, but the likelihood is very small. Like only 1 or 2% of unicorns will be created by one founder. So get a great team together, and then ensure that you validate the business model that you're working on. There's a ton of really exceptional teams that are just working on things that doesn't make sense because they just started building instead of spending some real time talking to everyone around them, iterating their idea, iterating multiple ideas, and then starting to build. If you do it that way around, you actually don't burn capital before you start building. So you also then have a longer runway, and you can get the prototype to the market. You can show real traction before you go and raise your seed round. So I think those are the kind of key elements to think through when you're racing. When that's said, one thing we also always tell our founders is you still need to talk to a lot of different investors because you're going to get a lot of no's. Spotify went to 23 investors before they got their first investment. And obviously, the 22 they went to before they got that 23rd were wrong. And the ones who came in and put $5 million into Spotify in their first round are now laughing all the way to the bank. So, you also got to believe that as a founder, that even if somebody says no, they are wrong and you are right. And then you continue on and you meet the next one.
Dream big.
Yeah.
So what are the biggest risks for these startups in getting from the seed to Series A funding?
Yeah, so I think the biggest risk is not being able to create momentum. Because in the startup world, momentum creates momentum. Once you get your first customer on board, getting the second customer is much easier. Once somebody starts talking about you, hiring the first person gets easier. Once you have your first investor on board, getting the second investor on board is easier. So you need to accomplish some of these milestones. And the best way to accomplish those milestones is in the early days to focus on building an incredible product. When we talk about building an incredible product, there's a difference between actually getting a lot of customers and just getting 5 to 10 customers that really loves your product and would do anything they can to that not disappearing. It's much harder to get someone to love your product than to get a customer. And you saw that a lot in 2021. You could just buy customers, right? If I give you $100 and ask you to give me $50 back, you would be my customer. I could run around here and get 1,000 customers in no time if net I give them $50. And that's a lot of what the behavior saw in 2021. Which is much harder is actually you telling me, I love your product so much that my life would be worse off if I didn't have it. Once you achieve that, then the momentum starts building. One customer leads to another customer, one investor leads to another investor, one great employee leads to another great employee, and you're on the roll. And if you have that, Series A becomes pretty easy. If you can't get that momentum started, the likelihood of not succeeding increases every day.
Right. Now, the startup investment landscape has also changed significantly since the 2022 tech crash. Investors aren't as patient as they were during the heydays of unprofitable growth companies like the Ubers and the Airbnbs. Does that timeline to profitability need to be shorter now?
I think for some businesses, it will still be longer. For others, it will be shorter. I think what is more important is, and I think it's very healthy. It's very healthy for the startup ecosystem that there is more rational behavior. Because one thing that happens if there's a lot of irrational behavior and a lot of irrational capital is that you compete against irrationality, right? Like if you're a great company and then your competitor just buys customers, they will get them and you won't get them when you should have had them. So there's a lot of positive parts of that. But ultimately, the way people need to think about profitability now is, yes, if you can reach profitability quicker, you should focus on that. If you cannot reach profitability because you're a capital-intensive industry, then show that as you grow and scale, you become more profitable.
And the startup funding has certainly pulled back in recent months, at least in the US with the cost of debt. Do you see this being temporary, or is this a sort of the new normal?
Yes, if you look at the data, actually on seed and Series A, there's almost as much activity as it was before. And at seed level and Series A level, the value is more or less the same. At the global scale, it's actually only down about 6% in terms of the valuation people can raise at. So there hasn't been so much of a change there. The biggest change is the time to closing the round. So if you look at our portfolio and you look at portfolios in general, it takes 4 to 6 months longer to close your round than it did in the past at seed to Series A level. What has happened is in the later stages, there's less activity because there's still repricing going on, right? So literally, people raised a lot of money in 2021. They still have capital. They're trying to make that work level longer. And I'm 100% sure that 24, 25, this will start ramping up to where it was previously. And if anything, it's kind of a healthy reset.
Now, before we dive deeper, let's turn to Alex Holmes from Oxford Economics. So Alex, investors love a good startup story. Can you talk us through some of the numbers from startup to unicorn?
Sure. We were talking about Facebook earlier, so let's start with that. Peter Thiel, a famous Silicon Valley investor, he invested $500K into Facebook at a $5 million valuation very early on in the seed round. And fast forward to 2012 when Facebook had their IPO, and that stake he cashed out, not even all of it, for $500 million US. Another example, Sequoia Capital, they invested $600,000 into Airbnb, a $2.4 million valuation, and now that stake would be worth about $7.4 billion US.
But Alex, while all these stories are great, it's about the people in the know making even more money. Are there any cases of the average investor picking these unicorn startups?
Well, there's a really interesting story of someone called Cyan Bannister. She was unemployed, homeless at the age of 15, and was a high school dropout. She started at the bottom of the ladder as a self-taught software engineer. And after a few years and earning a little bit of money, she started to invest in small companies. So she was a very early stage investor in SpaceX, and then later on in Uber. And those initial investments, some as small as 25K, have netted her hundreds of millions of US dollars.
Really paid off for her. Thank you very much, Alex. Now, back to you, Magnus. What about AI? How is AI changing the whole startup landscape?
I think artificial intelligence is probably the biggest technology shift that we'll see in our generation. We saw the advent of the computer, then we saw the internet revolution. Everyone knows what the mobile revolution has done to the world, right? We were talking about Facebook earlier. I think none of that can compare to what we're seeing now with artificial intelligence, because it will go into every single industry and disrupt it, make it more productive. I think it's an incredible opportunity for new founders who are getting started. It's an incredible opportunity for existing businesses to become more productive. It's an incredible way for society to, I think, take a step forward. And from an investment perspective, I think there are 3 groups of startups, and you got to be sure which one you're backing. So one is platforms. So for example, OpenAI is a platform that you can tap into their API. You can also use it as a direct customer, but mostly as a platform for other startups to build on top of. And that's where you're going to have like the next Google, the next Apple. There's probably going to be 2 or 3 of them, but there are thousands of people trying to be that platform play, right? It's very hard to be the next Google, but that's where you'll see the first kind of new $1 trillion outcome. Then there's the application layer, which are all the ones that are using the platforms, right? So, for example, Grab and Gojek here in the region, they're building on top of the cloud, on top of the mobile platform, and you will see other applications like this being built on top of AI. And there you'll see thousands of billion-dollar companies being started over the next decades. And so that's the biggest opportunity from a scale perspective, but obviously few of those companies will become $1 trillion companies. That's the second bucket. And then there's the third bucket, which is everyone who just throws AI into their pitch deck. And then those you should not invest into. And as whenever there's a big trend, whether it's cloud or mobile, or the last one was Web3, a lot of the companies are pretending to build something with AI, but they're actually not necessarily using it. It wouldn't necessarily make the company better, and they might not have an idea what they're talking about. So ensure you put your money in bucket 1 or 2 and not in bucket 3.
All right. Well, appreciate your time with us today, Magnus. That was Magnus Grimeland, former Zuckerberg Harvard classmate and founder of Antler, the world's most active seed investor. And thank you also to our resident expert, Alex Holmes from Oxford Economics. Thank you both. Startups, yes, many of them fail, but if you catch the right one, you can ride it all the way to unicorn status. Thanks for tuning into episode 10 of I See Your Trade. I See Your Trade is brought to you by IC Markets, the leading high-performance trading provider. Trade up to IC Markets. Thanks for joining us today, and we look forward to seeing you next time.